G'day folks, welcome back to another update for the S&P 500 and the NASDAQ. Now the charts are showing a bit of a retrace at the moment. Both the CCI and the price is broken down below the moving averages. We'll go to the charts in a moment. I'm going to include some back testing. Also make sure you hit that like and subscribe button to support the channel. And also reference the +1 videos for a deeper dive into our trading strategies. And remember, these videos are not designed for a 5-minute viewing and then go away and start trading. These are about watching these regularly and getting an idea of how to manage your trades more effectively with proper discipline. Okay, let's get stuck into the analysis. The global economy faces headwinds from trade policy shifts, export restrictions and structural shifts in global supply chains. US monetary policy remains critical. A softer labour market may give the Federal Reserve room to cut rates, but inflation and fiscal policy remain balancing acts. Valuations are elevated, prompting warnings of a correction or a pullback from major financial institutions. So first let's look at the S&P on the weekly chart, and what we've got here is the price is still above the moving averages on the weekly, and so is the CCI, although the CCI is pulling back towards that very narrow moving average band. The other thing to look at is the bearish divergence. You can see there are higher highs on the price versus lower highs on the CCI, and if I maximize that, you can see it very clearly, lower highs. So what that means is we've got to be very cautious. We might see a pullback any time towards these moving averages and possibly even further like it did back here. But at the moment, slightly cautiously bullish movements on the weekly. On the daily, just zooming in for a moment, again that's already broken below the moving averages of the price and also the CCI. Now here we've got a slightly almost double top on the CCI versus high highs on the price, so that could also be a bearish divergence. So we'll keep a close eye on that. And just to show a bit of history as well, going back here to about 2008, remember the GFC, we had a bearish divergence, broke to the downside, and then we had a little bullish divergence which helped us to identify the recovery. And I've identified here the major divergence. In between all these little periods there are smaller divergence, but I'm just highlighting here the major ones. Here we had the China slowdown and oil price collapse. Here we had the COVID-19 crash. This was the 2022 inflation and Fed tightening. And here more recently we had another break to the downside with a bearish divergence. Now in this one back here, there was no bullish divergence to identify, but again you would have started paying attention to the moving averages and the price breaking above the moving averages. So that's the daily to be aware of. So the daily at the moment is somewhat neutral to bearish at the moment. On the hourly, again zooming in from where we are at the moment, we try and identify any divergence, and also we look at a potential break to the upside. So that's a bullish movement on the hourly. But remember, on the daily we're neutral to bearish, so probably wait for the daily to start breaking higher before getting too confident to go long. Back here we had a bullish divergence versus lower lows on the price that broke higher, and that actually just drawing a Fibonacci on that, going back to that level before the divergence started. You can see there as a minimum we draw a 23 to 38% target range, and it broke that through that very quickly, and then it went as high as a 50% before collapsing further to the downside. And there's been, again, it's no divergence at the moment. The previous divergence to this one was back here. We had a bearish divergence. So if you're going long during this period, the CCI here was giving you an early warning to be cautionary about going long. The price moving averages kept rising until it finally collapsed, and that's where you would have got out of the trade. And I'll show you the back test in a moment for this one. And again, going back, we've identified a few divergence, bearish and bullish, along the period, and that's where you take notice of those. Now on the back test, we've gone back to April 2023, and that is because we trade in direction of the higher time frame. So we go back to the daily, April 2023, marked by this arrow here. You can see there the price is well above the moving averages, and that moving average band is still continuously in an upswing, and we still are in a bit of an bullish momentum. But again, always pay attention to the breaks below. That could be the start of a retrace to the downside like it was back here, for example. So on the hourly, we're going to start trading from the 23rd of April on the back test, and that's where it shows these periods, and that's where I'm saying paying close attention to, and I've zoomed out deliberately here because I want to be able to see the road ahead of me. I don't want to zoom in too close and seeing the bugs on the windscreen. So zooming out, so what we're looking for is divergence, bearish divergence here. You can see the price kept rising until that point there when the moving averages started bending to the downside. And you would have got out there possibly holding a position, a contract or two, but you still would have made some nice little returns had you followed the strategy. Again, going long according to the price, but also paying attention to the CCI bearish divergence here. And you would have got out of that little trade there, again, just before that drawdown on that one there. I won't go through the whole period, but you get the idea. Going long when both the CCI and the price are in an upswing, especially the price, but being aware of any bearish divergence. Back here, for example, we had a bigger drawdown. Again, getting out of that little trade there. The CCI was giving you a warning, and then the price started turning down. You would have got out of that trade, holding maybe one contract and avoiding that little drawdown. So at the moment, again, as I said, you would have got out of paying attention to the bearish divergence here. The price kept rising, keep holding on to that trade until it finally breaks. The moving average band starts to break to the downside, and you probably would have got out somewhere in that range there. So the weekly chart for the NASDAQ, very similar sort of pattern. We've got bullish momentum on the price, well above the moving averages, and also on the CCI, although the CCI has pulled back slightly. And again, similar to the S&P, this is on the weekly chart. We've got, you can see there, bearish divergence. And you would have paid close attention to that if you're trading on the weekly, and that broke down right through our 23-38% target range there. Quite flat during this period, but again, notice these divergences, getting ready. Again, just follow the price, but being aware of any bearish divergence, and that would have been a nice little rally to take on most of that period. Probably getting out of the trade there and then re-entering it on that one there on the weekly. Now on the daily, we go to the daily chart, and again, similar to the S&P, I've identified here the major pullbacks and also recoveries, and they would have been identified with divergence as well. So where we are at the moment, the CCI has broken higher from the previous highs, so there's no divergence currently, although the price is broken below the moving average, and so is the CCI, so there's no divergence currently on the daily. And then looking at the hourly, so again, we would have started trading back here on the 24th or 5th of April, according to the daily. And the hourly is also what we're looking for, is any divergence. And you can see here, actually, we've got now a higher lows versus lower lows on the price. So we're going short during this period, and this is telling us to be careful about staying short too long. And what we look at here is this little period, you would have got out of the short trade at that when the moving average started bending up, so you would have got out of that point there somewhere, and that was giving you an early warning with the CCI breaking higher as well. So you might have actually got out, if you're following the CCI trade, you probably would have got out first at that little period there when the CCI breaks into the moving average band, even though the price is still below, and then wait for it to break below again, and you would have got in again at that point around the same price range, let it run, and you would have got out of that trade on the short side on that bearish candle, on that bullish candle there, probably on that candle there when it broke, the CCI broke into the moving average band. That gives you an early warning. Let it run, let it go long. Don't go long because we want to make sure that the daily's in a long position first. Now we start to draw here, we start to identify any bullish divergence. That there was your first indication of a bullish divergence. You can see there's slightly lower lows on the price versus higher lows on the CCI. That was your first indication. The price went sideways for a while. It hit the moving average range of the CCI. You probably, if you're going short here, you probably would have got out of that little trade there. Make a few pips on that one, and then re-enter it on that candle there when CCI breaks below again, and then possibly get out of there with a few pips as well, getting out of any short trades. Or if you want to stay into it a bit longer term, as I said, follow the price moving averages and get out whenever the moving average range, remember what I said, whenever the moving average range starts bending up. So getting in there and getting out there. But again, you're at the mercy of the price moving averages as opposed to the CCI. So looking at the back test, going back to the 23rd of April, similar to the S&P, nice little moves. You can see they're averaged down a few times, but you would have got out of those trades, maybe holding a couple of contracts whenever you see the moving average bend down. And more recently here, you can see that massive drawdown. Again, you would have got out a little bearish divergence there versus the price, and you would have got out at the very latest with the price breaking below that moving average band. So holding maybe one contract near the high there of your profitability and avoiding that drawdown. And where we are at the moment, avoid going long. I haven't shown you the short positioning here, but it's just, you can get the idea. You would have gone short there and avoided and closing out your long positions at that point there when the moving average band started bending to the downside. If you'd like some share trading ideas, we do a weekly bullish share scan. We just did one this weekend, and these are the closed trades we've done recently. And these are closed and trades made since the 21st of September this year. In terms of monetary gains, we made 3,600, and that's trading small amounts. But in terms of percentage gains, that's returned us 9.67% in just over a month's worth of trading. We've got a few trades open at the moment, so just if you want to get more deeper dive into some of those ideas for share trading, bullish shares, why not subscribe to the Patreon page? So links to the Patreon page are attached in the description below. So click on the links to go to that Patreon page and consider subscribing. Hit that like and subscribe button. Thanks for watching, and I'll see you in our next update.